The broadcast is now starting. All attendees are in listen-only mode.
It's a great pleasure to introduce our next instructor here at Asian Investing Summit 2018, someone who's been with us in the past and has generously shared his investment philosophy as well as ideas with our community, and also someone who I had the fortune of welcoming to Switzerland recently and truly enjoyed the time spent together. Soumil Zaveri. Soumil moved to the US in 2005 to study economics and biology at Duke. He later interned with Goldman Sachs in New York on the healthcare team in the research division. He was extended a full-time offer there and joined the banking team after graduation. However, given the magnitude of changes affecting Western economies and the resilience of Asian ones, as well as his desire to be back home, after spending a few years in New York, Soumil moved back to Mumbai to start his own investment firm and to work directly on allocating personal and family capital. He founded DMZ Partners in early 2011 with his father Sanjay, who has played a key role in shaping his investment philosophy. DMZ Partners has recently transitioned from allocating only family capital to a SEBI-registered portfolio manager. Soumil and Sanjay therefore intend to cautiously curate their investor base to ensure that their investors' philosophies and expectations are well aligned over the long term. And knowing Soumil's investment approach, as well as the thoughtful way in which he approaches in ideas as well as the business side of things, I have absolutely no doubt that the firm will be a great long-term success. Soumil, I look forward to your remarks today. I'll be back at the conclusion for the Q&A session. For now, the floor is yours. Please go ahead.
John, thank you so much for the kind introduction. It's always a pleasure to participate in events you put together. And, I'm truly humbled to be presenting today. I hope I do justice to, the great events you always put together. Before I start on the topic for the day, I'd just like to mention that we and our clients own shares of securities mentioned in the presentation. And so I would urge viewers to kind of take note of the disclosures and disclaimers where relevant as you review any content. That said, I'll dive into the presentation. I'm not sure, do you see the slides change? I'm sorry, I'm just going to confirm that for you.
Yes, I do.
Okay, perfect. So I've divided today's presentation into two sections. In the first part, which will take about 10 or 15 minutes, I'll briefly recap on our update from last year, or our idea from last year. I'll also talk briefly about our approach to investing in India, and I'll kind of lay the groundwork for the idea I'm going to be presenting today. In part two, I will speak directly on the idea, which is a company called Teamly Services, which we think in many ways is an emerging domestic platform. So before I start with the content, this is just a quick snapshot of our journey. As you mentioned, I work very closely with my father Sanjay since I moved back to India in 2011. I'm going to skip on the minutiae of this slide, but those eager can always review at a later point. So before I dive deeper into the content, just a quick recap from our idea from 2017, Capital First, and some of our learnings from the experience. So we had presented on Capital First, an Indian non-bank financial, and we were very optimistic on its prospects over the long haul. However, in early 2018, in Jan 2018, the company decided to merge with IDFC Bank. And in our view, this dramatically kind of shifted the nature of the business model. So this led us to revisit our original thesis on the company, and we subsequently decided to exit the position. So our personal returns, we estimate to be upwards of 30% compounded since 2014. Please note these aren't audited returns. These are estimates from personal records. However, in our view, this was a relatively suboptimal outcome. We would have much rather preferred to own the standalone entity for substantially longer periods of time, given the very positive characteristics that we think the company had inherent in terms of its long-term prospects as a standalone entity. And upon merger, we felt that many of these characteristics would find themselves harder to kind of manifest on the larger and more complex business model that would be the merged entity. So this event also led to some introspection where, we internally create kind of very long duration expectations from the companies we want to own. However, this kind of reminded us on the powerful impact of what you may call special situations. And this can dramatically alter kind of the enthusiasm one may hold about the underlying business. So although the price rallied briefly post the announcement of the deal, it has been somewhat substantially lackluster. This made us appreciate another nuance, and that is that our best idea at any point in time is often unlikely to be the best idea for the year itself. And this is for two reasons. One is general noise and volatility, and the second is, certain such special situations lead to a situation where buy, hold, and forget may lead to suboptimal outcomes. So just to elaborate on that point a little bit, in terms of why a best idea is not necessarily optimal for the year itself, as silly as that might sound, the two key factors we focus on as investors, as long-term capital allocators, or the two key sources of edge, if I may say, we have are time and qualitative arbitrage. So what that essentially means is, A, patience, being substantially more patient than other allocators, and B, qualitative assessments of companies and the people who run them. Now, in both these situations, or in both these characteristics, these factors take substantially longer time to play out and manifest themselves than necessarily 1 year. And so I'd like to caveat that before I talk about the opportunity for today. That said, in terms of our approach, just to give participants a bit of a big picture idea, our predominant focus is looking for what we like to call these compounders or compounding machines, given the ecosystem we operate in and the long runway many companies have ahead of them in this environment. Now, although this is not done dogmatically, we feel there are 6 key criteria on which we score underlying investment opportunities. The first one is understandability. We want to be able to inherently understand the core prospects of a business and what makes it work. The second is competitive advantages. This may be 1 or 2 large advantages, or it may be, as you will see, sometimes a series of small but very consequential advantages that add up. The third is we need companies we entrust our capital with to be prudent allocators of capital. The next 3 points have a special India focus. First, we need to own businesses which can be substantially larger over a long period of time in terms of earnings power. The next is, especially given the ecosystem we operate in, we need our business high degrees of embedded resilience to alternative outcomes. So we particularly examine whether companies and business models we own are very sensitive to particular legislative or regulatory outcomes, and we try to be mindful of those factors. And probably the last point I'm noticing, but the most important in the environment, is the quality of people. You can't have a good deal with a bad person, and we're very mindful of that dynamic given the ecosystem we operate in. And because these are 6 factors, we call this approach as finding hexagons, because these are 6 sides that we need intact. And ultimately, we want to try buying these at relatively rational prices. So on the right side of the slide, you see this opportunity set. Basically, we're looking for the common ground between things we understand and things we think, and companies we think might be appealing. And that common ground is usually dominated by companies in the financials and banking space, consumption, and a whole host of different kind of companies that that we're slowly adding to our kind of zone of competence. And the bottom right side, you get a quick cross section of the kind of companies we've admired over the past decade or so. And of course, it's not an exact representation of our portfolio. So one of the common questions we tend to hear about investing in India is the sensitivity of the overall macro picture or political situations to the underlying investment theses of our portfolio companies. And that's why I like to show this chart to investors. In the last 20 odd years, we've had, very different types of governments led by different parties with different philosophies and approaches. Each time governments changed, markets reacted violently, irrespectively. We've had meaningful scams emerge over the last 20 odd years. I mean, in the last decade, you can think of things like Satyam, the accounting scandal there, which was a large IT company. More recently, you are seeing the issues with the public sector banks and some of the cronyism in lending, etc. that is being alleged more recently. So even on a single event basis, you had things like demonetization last year and the disruption that caused in the economy. And on an ongoing basis, you have pundits trying to decipher what happens in both houses of parliament and how that impacts, a whole host of listed entities. And at each time, astute observers of India or allocators in India had reasons to curtail their optimism or curtail their pessimism and fine-tune their expectations of their investments, of the so-called macro view. However, irrespective of all this noise, if I may call it that, about 50 odd companies of the listed universe did consistently well. And we typically tend to aspire to own companies that inherently possess such qualities of embedded resilience. Now, this is not to say that our companies can thrive in total chaos. However, we believe the vast majority of our portfolio will do just fine in a relatively wide scenario or wide variety of alternative outcomes. And that gets me to the middle piece of the slide here, which kind of depicts that thought process. We want to effectively own companies that do relatively well in a very wide range of outcomes. So we think this is possible in India for a couple reasons. One, on the left side of the slide, you see the low base effect. So we think very marginal changes in the scale of consumption can still have very large effects in the kind of companies or industries or sectors that they may engender. And the second, all our portfolio companies, irrespective of whether they're classified as mid caps or large caps, are still very nascent in terms of market share or adoption rates. So the largest of them may have 5 or 6% market share in their respective industries. And they are often competing with very large, inefficient, often misaligned competitors. So the playing field is simply not level. This gives us confidence that our companies can do quite well, even in relatively lackluster environments. And that's fundamentally because of their ability to take share away from incumbents. So with that said, I'll move on directly to the topic for the day, which is a company very closely related to the employment sector in India. And I'd certainly like to acknowledge upfront the irony of saying that macro doesn't matter so much and so on and so forth, and then go on to talk about employment generation and in particular a flexi staffing company. So that said, bear with me and let me share the broad contours of the nature of employment in India. Now, people are well aware of this demographic dividend, so to speak, and what comes with this very young population of more than 1 billion people. Now, more than 60% of this population is of working age. The workforce itself is estimated to be about 450 to 500 million people. But a critical nuance here is that only a small fraction of this workforce participates in the so-called formal economy. Even if you exclude agriculture, which is an important sector in terms of employment in the country, only about 1/3 of the workforce benefits from some kind of social security coverage. So even that is not completely formal. You could call it perhaps semi-formal. The vast majority of the workforce is either self-employed or employed informally with unregistered enterprises. In fact, out of the estimated 60 odd million enterprises in the country, only about 1.7 million are formally registered. In fact, if you look at recent labor industry statistics, certain industries like manufacturing and construction, where relatively small, medium enterprises are larger contributors to output, more than 70% of the employment in such sectors tends to be informal in nature. So this, low level of formalization, if I could call it that, anecdotally is due to two key factors. One is a general low level of tax compliance across the country, though I would like to caveat that this is steadily changing because of improved enforceability in a whole host of different ways. And the second, perhaps less evident to indirect allocators of capital, is that as a country, we are dealing with very outdated and onerous labor laws. And as industry veterans often joke that to comply with 100 labor laws in India, we need to break at least 20 of them. And so some of these laws dictate very, very onerous conditions of employment. To appreciate this further, it's interesting to know that 9 out of 44 central laws related to employment date back to 1947. In addition to these central laws, there's hundreds of state laws. So, there are, if you refer to some of these examples here, there are laws that dictate what you have to do if you want to hire more than 100 people or 300 people. And enforceability of these laws is actually quite poor in an official sense. So I believe there is an interesting study on the inverse relationship between the number of laws and the enforceability of those laws. So all of this dynamic leads to an environment where the so-called assessment officers who visit factories, etc., tend to become rent seekers. So in the past, many entrepreneurs have reacted to this dynamic by having multiple small factories as opposed to growing larger in one entity. And the inefficiencies, as you can imagine, that this causes can be quite immense. Now, although hiring can be quite difficult, firing is extremely difficult given the regulatory environment. You have legal cases date back to the 80s and 90s, still making the rounds in courts with regard to perhaps a factory worker who was fired for sleeping on the job and so on. So in general, compliance to labor laws, ability to hire and fire is considered to be a very large headache. And one could, further refer to some of the regulations I've highlighted here to gain more color, but I'll spare you the details. And based on our history, catering to populist needs, many past governments have kind of intended to empower low-waged workers by adding more laws. However, what this has done is translated to more laws, but less justice. So with that, I'll talk a little bit about the employment sector itself. The company I'm going to speak about today is an important participant in India's flexi staffing industry. Usually one thinks of flexi staffing globally as perhaps one of the most fragile sectors to macroeconomic factors and noise. However, in India, we think this dynamic is quite different for a variety of reasons. This is substantially a more sticky business than is typical in most, in developed economies where these businesses tend to be traditionally more cyclical. So globally, the flexi staffing industry tends to cater to seasonal variations in demand and so on. However, in India, many non-core requirements are almost permanently outsourced rather than building headcount in-house. Search and recruitment costs are very high, and spatially, as you can appreciate, things are quite dispersed. You may have a talent pool of engineers in a state down south, but a client may have a requirement for 100 very specific type of engineers on the East Coast, where finding and recruiting talent of that sort may be more difficult. Additionally, as I already highlighted, regulatory compliance is very cumbersome with regard to headcount. This is best handled by someone else, or a company could waste many man hours per 100 or 200 employees it seeks to add to headcount. Now, from the point of view of first-time job seekers, the flexi staffing industry has quite a compelling value proposition. One, wages, benefits, etc. are provided in line with all the kind of statutory requirements. And two, there's always the potential for conversion to permanent headcount. So India, moving on to the top right side of the slide, India is the second largest labor market in terms of number of people when I spoke about just being short of 500 million people. Yet the penetration of formal flexi staffing in the country is very low. The reason it appears so low is because the majority of this industry, which comprises of, call it 1.5 million people or 0.3% of the workforce, is because a bulk of this industry also operates in the shadows. Now, CRISIL research estimates that about 75% of this industry is informal in nature. However, when you speak to industry executives or you get a sense from different statistics, some people indicate that may be as high as 90 or 95%. The formal section of this industry comprises of 5 or 6 large players, of which team lead services is one. Now, the key reason the unorganized sector in this industry did very well is because of traditional regulatory arbitrage that it offered. I mean, you know, on the for first-time job seekers, on the one hand, have been desperate for jobs. India needs to find as many as 1 million jobs per month, and these unorganized players have gotten away with depriving new entrants into the labor market from statutory benefits, etc., that would otherwise accrue to them. On the other hand, these participants pay no service taxes to the government, so they're able to offer clients these services at relatively lower prices than the organized sector could. And so this dynamic has allowed the informal sector to proliferate in terms of flexi staffing. However, one critical aspect is that these entities find it very difficult to scale beyond a particular regional footprint, and especially beyond particular scale, because they have to attempt to continually fly below the radar. Now, moving on to the bottom left-hand side of the slide, we think there are several structural tectonic shifts in the way the economy is evolving today that, in our view, meaningfully reduces the viability of such informal participants, especially beyond a particular relatively small scale. And this has already started to anecdotally benefit organized players in the industry. The economy is being continually nudged to increasingly formalize, whether it is GST, which is the introduction of a single value-added tax, which replaced a whole slew of levies and surcharges, which were difficult to administer and even more difficult to enforce. And in fact, that had played a crucial role in bolstering the growth of the erstwhile, so to speak, informal economy. However, since the introduction of GST, the number of entities registered to pay these taxes have grown almost 50% in 1 year. And now, against the tax liabilities that companies have, they expect service providers to give them the input tax credits to set off against the services they use or products they buy. Now, unorganized flexi staffing agencies are, of course, unregistered and are typically not able to do this and pass on these benefits to customers. In addition to this, you've had one-time shocks like demonetization, which more or less crippled the ability of flexi staffing informal participants to keep their operations running, because they were heavily dependent on cash payments to associates and so on. And in addition to this, if you go across sectors, you have things in real estate like the Real Estate Regulatory Authority, which has been brought in to have more transparency and more accountability in the real estate sector. So all in all, what you're seeing is an improved focus on not just changes or reforms for the sake of it, but better enforceability in terms of introducing newer and more progressive changes. So all put together, we expect the flexi staffing industry to be one of the major beneficiaries of these transitions. Now, this gets me directly to the company for the day, which is Team Lead Services. Bear with me because the prices may not be absolutely accurate. It from a couple of days ago. And I'll jump right into what what the company here is. Teamlease is what you could call a people supply chain company. The bulk of the revenues come from general staffing, as high as 95%. And this largely involves matching the hiring requirements of customers, who are 2,500 companies who you have as customers, with the right human resources. This means that Teamlease maintains and grows a large headcount of associates, about 170 or 180,000, and places them at over 6,000 locations on behalf of these 2,500 customers. So some way to think of this is like a human resources bank, so to speak, because you pay your associate headcount salaries and earn a markup when you place them at end client locations. And in many ways, you can think of this as a platform business, and I'll elaborate on those kind of analogies a little later. Now, a small percentage of the revenue comes from what they call specialized staffing. This business carries a significantly higher margin profile, given that the employees hired and placed are more skilled for niche domain applications, for example, telecom or IT, and they usually command higher salaries than the general staffing segment. And this also allows Teamlease to earn a higher spread. The final piece comes from a whole host of different HR services that the company offers, ranging from regulatory compliance, payroll, etc. And this is more of a cross-sell opportunity that flows directly to the bottom line, so very accretive. Now, one of the interesting aspects of this business is that it's a price taker business. Both sides, cost and realization, are largely market determined. So there are only two ways to earn meaningful returns. One is improving the spread between what you pay associates and what you charge clientele. And this can fundamentally be done by continually improving the skill sets of your associate pool, which allows them to have higher realizations in the marketplace. And the second is using technology and processes to have very streamlined operations, because this really allows operating leverage to kick in meaningfully as the business scales by order of magnitude in terms of headcount. So all put together, the company earns about 2% net margins and just short of a 20% ROE. In terms of sectoral exposure, it's quite well balanced, with retail and manufacturing being relatively larger contributors. So one of the interesting statistics regarding the company is that they've helped more than 1.8 million people gain formal jobs since their inception. And so this hints to the scalability prospects when you consider that India has potentially a jobs problem, where you need to put 1 million people to work each month over the next decade. So the two founders, now moving on to the right side of this slide, the two founders, Manish and Ashok, are industry veterans. They are true specialists with regard to labor market dynamics in the country, and both play very complementary roles at Teamlease. So Manish is more focused on the advocacy piece and represents the company at various official forums, plays a keen role in pushing for progressive moves with regard to changes in the labor market in terms of reforms and so on. And Ashok is the more reticent and focused on the operational piece of the business, and continually looking for ways to leverage technology better, improve efficiencies, standardize processes, and so on, which has played a very critical role in the company being able to go from 10,000 associates to 50,000 to 100,000 and potentially multiples over the next decade. And anecdotally, they foresee themselves as potentially becoming one of the largest employers in the country. And just to highlight this interplay of two founders a little bit more, I really like what they said in what they were quoted as saying in one Fortune article, which is something to the effect of, if Ashok was running the company alone, it would probably be 1/100th the size. And if Manish was running the company alone, there would probably be no company left. And, I think this process of pull and push between two rational-minded partners is very critical to the evolution of a business over time, and truly can help build something exceptional in terms of a platform. So here we move on to the margin profile. As you can see, gross margins for this company have escalated from about 2.5% to about 4% more recently. So this is truly a razor-thin margin business. And when we say gross profit here, and these are gross margins, mind you. When we see gross profit here, what we mean is total revenues less employee costs, because employee costs are the key expense or the raw materials, so to speak. Even after you get to the gross profit level, core profitability net of all operational expenses is about 45% of that amount. So this slide is only really to highlight what a tough business this really is, and you can now appreciate why technology, operational streamlining, standardizing processes, these, so to speak, catchphrases are much more than catchphrases. They go a long way in a business where this is the contextual background. So it means something very different as opposed to a 40 or 50% gross margin business saying that, hey, we are streamlining operations. Here, the dynamic that it can create is far more emphasized. Now, this is a general trend of what the headcount growth has been. I mean, associate headcount growth has been roughly 20% compounded over the last 5 years, and revenues have grown roughly 27% compounded. As I mentioned, the general staffing business, which includes the 130,000 associates you see and the 40,000 trainees you see, is typically very low margin. The two interesting things to point out here are, one, given the strong role of advocacy that the company has with government, Teamly set up a skills university in partnership with the state government a few years ago, and this has been a very powerful way to source trainee headcount. The company also rallied strongly to renew the apprenticeship programs in the country, and despite being the second largest labor market, India has a woefully low amount, a couple 100,000 apprentices, and if you compare that to Germany or Australia, you'll witness that you'll appreciate that the difference is just humongous. So as you can see, they've been very successful in renewing some of these programs, and you can see how trainee growth has grown almost 2.5-fold in the last few quarters. The next column here is specialized staffing. As I said here, the spread earned can be potentially higher because these are employees with solid domain-specific expertise in either IT or telecom or so on. And you can see this has grown from 1,000-odd headcount to almost 6,000 in the last 5-6 quarters. So this is a small contribution to top line, but extremely accretive at the profitability level. And finally, the aim is to be able to continue to expand the so-called associate bank, if I may call it that, without commensurate expansion in terms of the operational expense footprint. One way this is measured is by the productivity of this associate headcount. When you take the headcount and divide it by the number of core employees required to manage this operation, and the productivity here has been continually improving from about 170 odd associates per core employee to over 220, or close to 220 now. Now, the company thinks this could be substantially higher over time, largely driven by tech. And so one of the things that they always underscore is that the technology and the operational platforms that worked when we were 10,000 people didn't work when they were 50, and the ones that worked at 50 won't work now when we are at 180, and so on and so forth. So this is the kind of continued focus to push the envelope, and in so many ways, more informal or less tech-oriented people will just stumble here. So just to step back, I want to kind of reiterate the idea here that this is, as you can now appreciate, a very tough business. We certainly don't want to sugarcoat the reality that this is a business where there is practically no barrier to entry. There's no pricing power. There are no clients have practically no switching costs, and so on. So what makes this business appealing? The idea is that this is a business where barriers to entry, in our view, are very low, and barriers to success are incredibly high, especially at scale. So as you can see from the colorful depiction I've put together on the right side, this is typically the business that is very easy to understand or conceptualize, but very difficult to execute. And that's why we think the moats are built in this type of space. At the risk of being a little repetitive, I'd like to reiterate the idea from last year's then one big moat. There's this idea of so-called a dozen odd mini moats, which can also build a successful business model, which allows you to have 20% type ROEs that can be juiced out from that business model and redeployed at scale. And this is where the real moat in a business like this comes from. Now, there's two mental models I like to share with regard to the nature of this entity. The first is a platform. On one hand, you have a continual flow of job seekers entering the market looking for decent pay, employment conditions, and an alternate to the so-called informal employment where there is very little job security, leave alone things like social security coverage and so on. And on the other hand, you have companies incurring very high search costs in looking for the right set of people, right skill sets, especially at scale. As a reminder, this is not a company looking to build a team of 5-10 people, but you're looking for very particular skill sets and getting 100 or 200 of that type of headcount. So this is a win-win for both sides, and TeamLease is the platform in the middle, which helps companies deal with these kind of sky-high search costs, regulatory burdens with hiring and firing, which are all done away with. On the other hand, associates are looking to gain kind of suitable employment, fair wages, as mandated by the law of the land, and TeamLease offers this with the additional benefit, I would say, of potentially becoming a full-time placement at the client level, subject to performance and so on. In another way, the company can be thought of as a human resources bank, so to speak. So just like you would conceptualize the balance sheet of a bank, on the liability side, just much like a bank has deposits, you have associates that you've hired onto your balance sheet. They come with a cost in terms of the cost of liabilities here. And on the asset side, when you place these associates with companies, you earn a markup on those associates, and you can typically think of this as the yield on your assets. In case of TeamLease, this is about 800 rupees a month per associate. So really razor thin, and of course this gets higher when you talk about specialized categories. Now, your ability to leverage this balance sheet, so to speak, is defined by how many associates, how large a headcount you can manage by leveraging technology and your core employees without commensurately increasing your operating expense. Now, as a final, because we've drawn this analogy to banks, I'd like to say, just as private sector banks have kind of taken market share away from their larger, inefficient public sector peers, we think in many ways TeamLease benefits from a similar dynamic, where you're able to take away share from informal market participants who in aggregate represent the industry behemoth, right? And this is a very powerful dynamic. So here I'd like to quickly talk about the corporate structure of the company. I'd say there's three key points here. One is, I think, although it looks like they've been quite acquisitive over the past 2-3 years, this is much more measured than is typical in this industry. And also the criteria for what makes acquisitions compelling is quite explicit. So they had a suboptimal experience in 2009 in their acquisition of an education centers business called IIJT Education. And I think they realized that this was a difficult business to scale with regard to capital and not really optimal in terms of the return profile. And I think it has played an kind of an imprinting role in terms of helping management team have this case study of how to do things kind of differently. Now, second, one of the powerful dynamics in this industry is that often small participants, small operators, often want to sell their businesses because they find they lack the management depth and width to scale beyond a particular headcount in terms of the associate base. They may have regional strengths, but not the bandwidth to build a national footprint. And so these are kind of ideal situations for TeamLease to go in and acquire. And that kind of gets me to point number 3. And this is about their explicit mindset to create what they call opening balances in particular niches. So when they want to enter telecom staffing, for example, they have this concept of, take the example of Evolve Technologies, one of the companies here. The company was keen on building this presence in telecom staffing, they realized that building these so-called opening balances of the first few in terms of headcount is very difficult with new clients and can take time. And so this gives them the opportunity to acquire a business which may have built these so-called operating or rather opening balances, but have difficulty scaling beyond a particular headcount. Now, with TeamLease's experience in the general staffing segment where headcount is, orders of magnitude larger, that's not a problem they face. So this becomes an ideal situation where the acquirer can leverage these opening balances, build a larger headcount because of their deep experience in general staffing, and really leverage existing client relationships. And they call this the farming strategy because, typically what you have is your clients may be giving you 10 or 15% of the business that they typically give out. And you have this opportunity now because of your scale and ability to build larger associate headcount to go in and farm for higher wallet share of clients. And so that's a compelling dynamic. And so you can kind of think of this as a roll-up strategy where you use free cash flows and you can do something very, very value accretive in that sense. Now, the last point I want to make here is TeamLease has also been very proactive, as I've repeated multifold, on its approach toward technology, and they've done things, with building small stakes in online learning courseware companies and so on. And the way they think of this is these can be overlaid on the complete associate headcount, so to speak, to improve skill sets and improve employability across kind of client requirements or sectors or industries and so on. And this is evident in their investment in School Guru, which is an online courses company, which can then be leveraged across the whole TeamLease University platform. The other progressive move was also with taking a small stake or a 40, I guess a 30% stake in an entity known as Freshers World, which is an online job portal. And what they are doing here is kind of widening the sourcing funnel on the supply side of the platform and being able to add headcount with fresh job seekers or first-time job seekers, so to speak. So two very different points I want to drive here. On the left-hand side is learning from past experiences. We typically have a strong preference for companies that have gone through this kind of trial by fire or some type of difficult experiences or traumatic experiences that they've emerged out of, which have created this kind of institutional bank or memory, which helps them behave more rationally going forward. And the first one I hinted about, which was the acquisition of IIJT. And the second one I'd like to point out is that, going into the financial crisis in 08-09, the company had almost a 70 or 75% exposure just to the banking and financial services sector. And so going into the crisis, they had revenue shrink by a half, headcount shrank by almost 45%. And this kind of imprinted on the management team that, hey, we need to build balances across industry verticals relatively aggressively. So that led them now to be so much more kind of spread out in terms of industry contribution or sectoral contribution. And even in sectors where concentration industry-wide, call it manufacturing or retail, is relatively high, it tends to be more granular in terms of underlying clients. The second big point I'd like to talk about is that, unlike most staffing agencies or smaller or mid-sized staffing agencies, this is a very purpose-driven organization. The team is very eager to help solve this jobs challenge in the country, which the country is likely to face over the next decade. And this is done twofold. One is because of a strong focus on advocacy. Their intellectual leadership is well respected in the entire sector, and senior leadership is very kind of tuned in to the way government is thinking and tries to play a progressive role in terms of advocacy and shaping reform measures, suggesting reform measures, and so on. And the second is a big push toward employability. So the company is not simply focused on the staffing agency business. A big motivational factor, if I may call it that, is improving the employability prospects of the complete of the whole headcount base. And they do this because of through some of the acquisitions I spoke of, leveraging the courseware and the learning across this headcount. And the second is by being involved directly in terms of Team Skills University and really improving the prospects that their headcount have in the job market, both in terms of being placed, having potential for permanent employment, and in terms of improving the kind of realizations they have as labor industry dynamics keep evolving. So in terms of both the shareholding structure and the IPO in 2000, I'll perhaps start with the right hand side. The company went public in 2016, and the stock has done relatively well since. The predominant mindset behind going public was to allow for partial exits for a few private equity entities, and the new issue was roughly 1.4 billion in terms of a fresh issue of shares. And mind you, this is a relatively small amount of capital when you consider that it's about 1.5 to call it 1.5 years of worth of free operating cash flow. So really not that much in terms of scale. And one of the ways we identified this company is we were looking for companies that went public but didn't raise much capital. And that was one of the kind of mental models we were running at the time. And they've used these proceeds predominantly for acquisitions. And I've shared the bulk of the rationale on that front. In terms of the left-hand side of this slide, a few private equity investors trimmed their holdings, and a bunch of institutional shareholding came in. So liquidity is relatively tight, and only a small percentage of shareholding is in retail hands, so to speak. So now this is a quick glance at scale relative to global peers. I'll be mindful of time, but all I'd like to highlight is that if you look at global peers, some of the largest among them, Adecco and Randstad, you have a head count of 180,000 at TeamLease versus close to 700,000 for both the other peers. And mind you, the global peers operate in 40 to 60 countries, whereas TeamLease operates in one country and kind of has a continued domestic focus, so to speak. Now, when you kind of consider the scalability prospects here, it really helps you appreciate how things can play out over the long run, because organic growth at the global peers ranges from 6 to 8%, and what you're seeing in India is long-term associate headcount growth can be in the range of 15 to 20% because of enough on the supply side and demands for finding right skill sets on the demand side. And this is really why we find this to be very well positioned in terms of the broader picture. So here I'll just quickly highlight some of our expectations over the long run and what that translates into in terms of fundamentals. So number one, large inefficient incumbents controlling more than 75% of the market, getting disrupted, so to speak, to use a kind of perhaps cliche term, but you have this informal side of the industry becoming less and less viable. What this implies in terms of fundamental is that we can have a fair degree of conviction in 15 to 20% type headcount growth over the next decade in a business like this, as more and more of the economy formalizes. Second, this is a difficult to operate business, of course, but even much more difficult to scale. And so you have small and medium and inefficient practitioners getting kind of capped out at perhaps a couple thousand sized headcount. And so market share gains, again, at the expense of not just informal, but relatively limited bandwidth participants can be quite high. Third is, this is an industry, and perhaps I've not done enough justice to this point. This is a space where customers who are, companies are very paranoid about compliance. Now, very few flexi staffing agencies or practitioners in this industry have the intellectual bandwidth, so to speak, to keep updating their clients with regard to regulatory updates and be very sure that clients have been regulatory compliant in all ways. And what this leads to is the company can, on the fundamental side, is that the company is able to launch these so-called hunting and farming campaigns and have this continual focus on customer wallet share. One thing astute participants may have observed is that the client count is almost 2,500, and the top 10 concentration is about 18 or 19%. So even though you have 2,500 clients, you have 10 people or 10 companies contributing a very large percent of your revenue. Now, this is a great depiction of what this farming campaign or farming opportunity can be in terms of getting more and more wallet share from that relatively thin tail of clients. The next point is on improving margin profile by targeting niches. So telecom and IT is a great example here. The margins in these kind of niches, gross margins, could be, substantially higher than they are as you noticed in general staffing. So in these type of spaces, margins tend to be 15% or higher, whereas gross margins in general can be 2.5% or 3% sometimes. So this gives us conviction on the fundamental side of things, where we expect profitability margins to keep improving from where they are today. The next point is on leveraging technology to be able to continually handle larger associate headcount. So as you see, global peers are at 700, 800,000 people, and we think there's potential for a company like this to set a new precedent in terms of how many employees one entity is capable of managing, so to speak. And this is largely translates into higher productivity. So productivity ratios can move materially higher from where they are today in terms of managing that associate headcount without very large increases in the core employee base. And the final point is we continually expect them to acquire kind of intellectual depth in tangential areas, like whether it's jobs portals for continually keeping that sourcing funnel wide open in terms of first-time job seekers, and online course providers for kind of enhancing employability prospects, improving realizations that the associates see when they are out in the marketplace. And this allows us to have some degree of certainty about what long-term realization growth can be. With that, I'll move on to a few more caveats here. Unlike last year, we moved away from perhaps detailed 10-year models, but we think in businesses like this, if you think of value, 1 year forward earnings is about 40 times, which is certainly not a bargain. But we'd like to highlight that 1 year forward can be very misleading in environments where there is meaningful structural growth like this. And given some of the factors we hinted at, we think bottom line growth can be in the range of 20 to 25% over a long period of time. And I want to be repetitive of the factors driving this. I will, however, add to this that we do build detailed 10-year kind of models for our own mental clarity. We've just become a little reticent in sharing these widely, given how circumstances can change with regard to special acquisitions or situations like that. We also hold that very few businesses lend themselves to such a build out in terms of the certainty factor over the next decade, and we think this company is no exception to that kind of mental process. However, we have to be mindful of not letting long-term projections be viewed as estimates or projections with regard to regulations. Moving on to risk factors, we think there's few company-specific points here. One is, I won't go through all, but one is a high exposure to a single business line, which is general staffing. With regard to more thematic concerns, there's always the mindset that we need consistency in terms of regulatory support, government support, with regard to how the temporary staffing industry is viewed in form of recognition and incentives and so on. The other, I would say, is the continued news and the stuff we read about the impact of artificial intelligence and technology and the impact that can have on relatively entry-level jobs. So those are two areas which one needs to be mindful of. So overall, some of these, going back to our 6 key points, we think in many ways TeamLease is a good candidate to be called a hexagon, so to speak. We think the company is understandable. The prospects are easy to identify over the long run. There's no single competitive advantages. As we mentioned, barriers to entry are very low, but there is this group of advantages of small micro advantages that in aggregate become quite impactful. We think experience has taught them to be quite prudent in terms of allocating capital and free cash flow. In terms of scalability, we think the informal sector is the largest incumbent here, even though it's not one entity. In aggregate, it represents the industry behemoth, and there's many reasons to believe that the weight they hold in the industry in terms of informal participants will keep reducing over time. The next is resilience to alternative outcomes. We think a company like this gains resilience with scale. 2008, 2009 definitely exposed certain vulnerabilities which have imprinted deep learnings on the management. In terms of quality of people, we're very confident that this is a passionate and purpose-driven group of founders and management team, and have meaningful alignment in terms of their personal skin in the game as well. Finally, I get to the point on price. This is certainly 40 times next year's earnings, or depending on how estimates are, certainly not a bargain price, but in our view, long-term allocators ought to take a closer look. I've been rambling along for a while. I thank you all for patiently listening. I'll stop here and happy to take questions, John.
Well, Soumil, thank you so much for such a comprehensive presentation, both on TeamLease as well as for setting the stage so well. Just a reminder to everyone listening, if you have a question, feel free to type it into the online interface at this time. Could you perhaps elaborate a little bit on the pricing model and how that works in light of the low gross margin? It seems like the pricing model would have to be somehow tied in with the costs of the company to ensure that gross margin doesn't turn negative in bad times.
Yeah, absolutely. So this is typically a cost plus markup model. The way most of these contracts with their clients are is that the employee costs are covered, and plus there is usually a fixed markup in rupee terms in terms of pricing. What the company is doing is continually trying to transition to a variable markup model as opposed to a fixed markup, and they're having some degree of success with clients in doing this, and that's anecdotally it seems to be improving as the intensity with which informal market participants were competing earlier is starting to abate. And so, yes, certainly not a price, not a business in which you get to set or command prices, but certainly a business where the extent to which they were price takers is improving with regard to have more and more of these contracts done on a variable pricing or a variable percentage model, as opposed to fixed markups relative to their employee costs.
And Soumil, you had that instructive slide showing both kind of a platform view as well as a bank view of TeamLease. On the platform side, it seemed like they take on, or rather on the bank side, they take on this liability of this labor. Um, just if you could elaborate a little bit on that, because it sounds like they don't actually hire people full time unless they're placed with customers. Is that right?
Yeah, so typically the way it works is they hire people full time onto their payrolls and subsequently place them at their at with the end clients or customers. And most of the, most of the time these are driven by clear visibility on what the pipeline is in terms of opportunities for placement. So they are full time. They are hired as employees that subsequently get placed, but in all ways they gain all the statutory benefits, etc., of what would be considered full-time employees. So they are full-time employees of the company.
And so what is the definition of associate headcount versus full-time employees, where you have that slide with Adecco and Randstad, and basically all the companies have a lot more associate headcount rather than what they call full-time employees?
Yeah, so one of the distinctions here is what you would think of as core employees. So core employees are employees you need to manage this headcount. So a lot of the HR responsibilities that a company as a client would have with regard to payroll or managing the employee base remains with team leads. So, on this slide, for example, you see an associate headcount and you see what is, perhaps this should be titled as core employees. The core employees play a very significant role in supporting this type of headcount and supporting their companies with who are clients with regard to all the non-core aspects associated with managing this headcount.
Understood. So they're all full-time, but associate headcount are actually the employees that get sent out for the staffing assignments, and what's shown here as full-time is really the internal staff of the company that runs and manages the business.
Absolutely. What would have been more clear would be to consider that as core employees, because they are core to the operational running of the business and to be able to manage that overall associate headcount, so to speak.
Understood. Thank you. There's a question on slide 10, or on a point you made there. Could you elaborate on whether and to what extent the possible deregulation of labor laws in India could erode the moat of team lease?
Yeah, absolutely. This is a point that comes up quite often. In our view, there's even though labor laws, even in a scenario where labor laws keep getting more and more streamlined, less and less onerous, there is still the problem of very high search costs, very high matching costs, if I may call it that. To India, India is an ecosystem where we may have many graduates with a particular skill set, but what many companies and HR departments of companies lament about is that the title or the qualification is not necessarily indicative of the underlying skill sets that are required on the job. So irrespective, we think there are many moats beyond just the fact that labor laws are onerous. We think, even though labor laws may become more and more streamlined over time, this dynamic of finding it very difficult to find people at scale will remain. And so that's one of the very large contributors to a moat in a business like this. And the ability to handle non-core staff is considered is likely to be a very large asset for a company. And so we think the source comes from many factors, And even when we talk about labor market getting more and more formalized, that is likely to be a steady process over years, not something likely to happen overnight. In fact, it could be a welcome move where companies like Teamlease will be able to, with more streamlined labor laws, be able to operate at significantly larger scale and higher productivity. So that keeps us confident that this is not solely an arbitrage business in that sense, where because laws are onerous, you have the existence of companies like this. We think even in an environment where laws keep getting more and more rational, you will need, so to speak, a platform to be able to find 200, 300, 500 people for a launch of a product. You will need 1,000 people for your sales staff, and that will not necessarily be headcount you want on your balance sheet, so to speak. Full-time headcount you may need on your balance sheet. That truly ensures that the HR department's man hours, are not spent on recruiting, and then subsequently on training, and then on firing and refinding people. And so those dynamics remain.
And Soumil, perhaps lastly, looking out over the very long term, how do you look at potential threats from online models? I understand this is not an issue now, and it's even a channel for Teamlease. But in light of the fact that the gross margin of this business is fairly low and there's the platform aspect, is it conceivable that over the very long term, there could be some viable competition that does it mainly online? And if so, is Teamlease actually taking any steps in that direction to sort of enable themselves to be that platform?
Yeah, that's a great question, John. In many ways, I think online is an enabler for the company because, through some of the small acquisitions they do in terms of taking small equity stakes in online portals and things like that, it's something that they experiment with, and they consider how that can be overlaid on the entire headcount. That said, with regard to the crux of the point, in many ways, we think this is a business where, it's companies need to have clarity and conviction of the nature of headcount, the nature of staff that they bring in to their client locations. They want to be sure of the quality, the long-term kind of employability, the skill set, the capabilities on the job. And I think many of these things become harder to quantify on an online platform, and only become apparent after the decision is made to have someone at a client location. So in that sense, I think it will be a business where you will need to assess a lot of qualitative factors with regard to your associate base, and accordingly place people. And I'm not sure how quickly or rapidly that will lend itself to becoming a completely online type of business. And I'm not sure if I answered your question, so feel free to elaborate so that I can better answer it, perhaps.
No, certainly that is very helpful. Thank you. With that, thank you all for joining us. Should you have further questions or thoughts for Soumil, do feel free to follow up with him, either directly or through us. We would be happy to facilitate the introduction. And with that, Soumil, thank you so much for being with us once again and for taking the time to share your insights with our members. We do appreciate it.
Thank you very much, John. Always a pleasure.
Goodbye for now.